I am Moni Lindsay, Managing Director and Head of the London Office of Treasury Strategies, and I'm joined on this call by Tony Carfang, Partner of Treasury Strategies. We're excited today to be joined again by our panel from the last briefing, whose organizations are also sponsoring this event. So Martin O'Donovan from the Association of Corporate Treasurers, Debbie Cunningham from Federated Investors, and Scott Horan from PNC. I will provide further background on our panelists before the panel discussion. A bit of background on these briefings. Corporate liquidity has long been a significant aspect of our consulting work for both corporates and bank customers of Treasury Strategies. We began these briefings and the research behind them several years ago to understand at a deeper level the story behind cash hoarding that was continuously in the press. So we began tracking the central bank quarterly reports of cash levels from the Bank of England, European Central Bank, and the Fed, and we've also added other central banks in Switzerland and Japan. We've continued to formally and informally survey and have one-on-one discussions with our corporate clients to better understand the drivers and plan changes around cash levels and management of those cash levels. Today, we are pleased to share with you our latest findings and join our panel in discussing the implications of the continued myriad of economic and regulatory changes impacting the level of balances and how they are managed, whether it be money market fund reform, the impact of Basel III, or Bernanke's hint at the end to quantitative easing and subsequent market reactions. A word before we get started. Our 45 minutes today gives no time for Q&A. However, we want to take your questions, so please type them into the question box at the bottom right-hand corner of your screen, either during or at the end of the webinar. We'll circulate the answers to all who have registered. A quick overview of the next 45 minutes. Tony's going to share the latest reported cash levels. I'll review key highlights from our recent survey of corporates. Then we'll introduce our panel, which we will kick off with Tony's overview of the potential game changers. After our panel discussion, Tony will share the advice we are giving our clients, and then I'll wrap up. So let's get started. Tony, what are the latest reports from the central banks telling us?
Well, Moni, hello everyone. We are hot off the press with some very interesting and new information this morning. First of all, a couple of weeks ago, the U.S. corporate cash was reported to be up 2.6% during the first quarter of 2013, right in at just under 1.8 trillion, continuing its upward rise, since we've been tracking these statistics and going back to the year 2000, as you can see on the top left-hand corner of the chart. The breaking news, just within the last hour and a half, the Office of National Statistics in the UK significantly revised its time series of UK corporate cash. And as you can see here in the top right-hand box, corporate cash was reported at about 520 billion pounds, which is down from 730 billion that was reported 3 months ago. Actually, they revised their entire time series, so the quarter-over-quarter increase is 3%, very consistent with what we see in the U.S. But the huge revision, the 30% downward revision in the entire time series, is certainly a matter that we plan on investigating further, and frankly, we find this disconcerting. About a year ago, the U.S. Federal Reserve decreased its estimate of U.S. cash and revised its time series downward by about 20%, or 500 billion U.S. dollars. Now we're looking at a 200 billion or 30% decrease in UK corporate cash. These are not statistical anomalies. These are major revisions that the central banks or their adjuncts are making. And we have to ask the question, what's going on here? I mean, we have regulators making decisions that impact all of us, apparently based on data that is not terribly reliable. Hopefully, as a result of doing webinars and speeches like these, we've put the regulators on notice that these numbers are being watched, and perhaps that's the reason why they're putting the numbers on the microscope and making a revision. Now, the Eurozone reports, the ECB reports Eurozone corporate cash on somewhat of a delayed basis. So the most recent numbers reported were as of year-end, and there we saw a quarter-to-quarter increase in Eurozone cash of about 4%. Now, if we look across the last 13 years now of our corporate cash index, which we initialized at 100 in early 2000, we see that the Eurozone and UK cash has more than doubled, and the U.S. corporate cash has just slightly less than doubled. You know, I have to ask myself when I look at this chart, and like I mentioned, we just got this data about an hour and a half ago. The new UK time series is moving almost in lockstep with the Eurozone time series, and you know, obviously there should be linkages there, but boy, these numbers look suspiciously close together. When we look at the actual UK revision, we can see over the course of the entire time series that just about every data point has been revised. And for those of you who've been listening to our last several cash briefings, you know, we've been speculating about when the Eurozone and UK corporate cash numbers began to diverge, and now we're seeing clearly in these revisions that diversion took place primarily between 2003 and 2007. So here at Treasury Strategies, we will be working over the next quarter to try to more deeply understand what the heck is going on here and how all of us in the financial community and corporate treasury need to react and reposition ourselves based on these numbers. Now, as you know, we started measuring corporate cash as a percentage of GDP a few years ago, and we're seeing, you know, in the United States over 13 years, U.S. corporate cash has gone from 10% of GDP to 11%. Not much of an increase there. Eurozone from 14 to 21. Last quarter, we showed UK corporate cash in March of 2000 at 27% of UK GDP. That's now been revised downward to 25. And last quarter, we showed UK corporate cash at about 47% of UK GDP. The current number is now 33%. So you know, these numbers are coming into line. A lot more study to do here, though, again, to figure out what the heck is going on. We think it's very instructive to look at the reserve balances of central banks. You know, one of Treasury Strategies' tenets is that the central banks have so disrupted and confused the markets as to become a drag on the economy in and of themselves. In the upper left-hand corner, we can see the current quantitative easing of the U.S. Federal Reserve kicking in, and the Fed is buying $85 billion worth of securities per month. We're starting to see that line tick upwards at roughly that rate. If the Fed does continue through 2015, as they kind of sometimes indicate they might not, that number gets up to $3 trillion US. Bank of England, reserve balances at the Bank of England have been actually fairly stable, relatively flat. But if we look down at the bottom, in reserve balances at the ECB, they've actually been halved over the last year. Again, what we're seeing is some inconsistency, and certainly this raises questions in the minds of corporate treasurers about, you know, what's really going on in the marketplace. And during our panel discussion, we have some particular insight into this huge fall off in Eurozone GDP. Last quarter, if you recall, we spoke about the Bank of Japan's then recently announced quantitative easing program, and we're already seeing the first spike in the upper left-hand chart. Swiss National Bank at about 500 billion Swiss francs seems to have been flat. So yeah, we have a lot that's going on here, a lot of changes, a lot of interference in the market. So with that, let me turn the mic back to Moni Lindsay, who's sitting over in London, with an interesting perspective on what might be underlying all of this.
Thanks, Tony. So as you mentioned, now we want to look at what some of our clients are saying. We recently went out to our clients via our LinkedIn groups with two questions. The first was, when will interest rates begin to rise significantly? And then the second was, what impact will Basel III have on corporate finance? Now, we received over 1,600 responses globally for the interest rate question. And then we received close to 300 responses for the Basel III question. So thought that was interesting. Now, if we look at the response to the interest rates, you can see that just over 40% think not until the rates won't go up significantly until 2015 or after, and another 20% think it's the end of 2014. Over 30% think rates will rise significantly in the next 12 months, and some as early as third quarter of this year. Now, if we look at some of the comments that accompanied these, most really favored the delayed increase in rates. However, I think it's important to note that the survey and these comments were pre-Bernanke's hint of the possible end of quantitative easing, and then the Bank of England's decision not to increase QE. So there's been much speculation since then of that rate increases may actually come about sooner. So at this point, it's anybody's guess and lots of speculation. When we asked about the impact of Basel III, what the impact will be on corporate finance, the general consensus is a reduced role for banks, both in funding and in taking on deposits, and an increase in shadow markets and other lenders. Only 5% think there will be no impact on corporate finance, with banks retaining key deposit and only 25%, with banks retaining key deposits and lending roles. Again, the comments really echoed the survey results. The general sense that banks cannot use their balance sheet as much as they could before, and that the banks will remain important, but merely on facilitating access to capital markets. There's a sense that non-bank entities will emerge, and that more regulation and burden on banks is really not the answer to our woes. So very interesting and a backdrop for our panel. What I'd like to do now before we move to the game changers, which Tony's going to discuss, is actually introduce our panel. So let me introduce Martin O'Donovan, who is Deputy Policy and Technical Director at the Association of Corporate Treasurers, where his responsibilities include the provision of technical guidance and regular updates to members, as well as representing the views of treasurers to government, regulators, and standard setters. The Act is a professional Treasury organization headquartered in the UK, but with members globally and delivering international qualifications globally. Debbie Cunningham is Executive Vice President and Senior Portfolio Manager and Chief Investment Officer for Taxable Money Markets at Federated Investors, a leading investment management firm and pioneer on money market and fixed income funds. Scott Horan is a Senior Liquidity Management Executive at PNC, a leading financial institution. He's responsible for short-term cash investment products, including PNC Bank liabilities and various third-party money market funds used by Treasury management clients. So Tony, can we talk about and get our panel's insights on the potential game changers?
Sure, Moni. As you can see on the chart, we've identified 5 game changers that we believe you all need to keep your eye on. Too big to fail is still a debate that's raging in the marketplace. Regulators are chiming in, and as a matter of fact, the regulatory processes are moving on at a pretty good clip. Fortunately, we have 3 experts joining us today who are fully prepared to opine on that. The transaction tax rolls forward with unknown consequences. That will be a fascinating question for our panel. We talked earlier about the monetary policy of central banks, and again, as Treasury strategies, we see in our own consulting practice, our clients are just confused. Should they stretch for yield now, or do they take a lot of risk because the central bank's policy could abruptly change? And with all this confusion now in the marketplace, should they just sit tight and do nothing? Important questions. Basel III, as we move around clockwise, as Moni commented, doesn't look like great news for the banking industry's traditional banking functions of lending and deposit taking. Our respondents felt very strongly that those roles could migrate somewhat to other institutions or even new products, or what we call shadow markets here. And then, of course, the money market mutual fund reforms. An extremely high percentage of corporate treasurers invest in money market mutual funds. They've been under attack worldwide, and we think we're getting down to crunch time here. So with that as a backdrop on the game changers, let me begin by directing a question to Martin about the European Central Bank and the 50% fall off that we saw in reserve balances at the ECB that started about 3 or 4 quarters ago.
Well, specifically that tail off, we suspect, I think it started in July last year, and that was the stage when the central bank moved its deposit rate for banks from 0.25% down to 0. So it's not surprising in a yield basis why banks would no longer wish to place their funds with the central bank. What's perhaps more remarkable is that they still feel it's worth doing so to have the safety and protection of being with a central bank, even though those balances are not being remunerated.
So, Martin, as a follow-up, your sense would be that the real news on that chart is that there's any money at all at the ECB?
Well, the significant factor is that the banks between themselves must still be somewhat distrustful and therefore prefer to place their money with the central bank rather than through the interbank market.
So we would hope to see those numbers continue to decline as the European economy recovers.
As confidence grows, yes. And certainly it would be good news if there is more liquidity and activity in the interbank market.
Fantastic. Debbie, you manage a number of European money market funds. How has the rate cut that Martin referred to a year ago and these huge cash flows impacted the funds that you manage?
It certainly made it a little bit more challenging, Tony. Over the course of the second half of 2012 and then into the current first half of 2013, there have been quite a few times in the marketplace when traditional trades that we would be doing would be offered at negative rates, and that was, both for sovereign short-term credits as well as banking short-term credits. Well, obviously, as you well know, we're not in the business of giving back part of our principal in order to reflect the negative interest rate that would be undertaken or that was being offered. So, we avoided those situations, and it's gotten a little bit better, I might say. But there are still certainly days when that becomes, sort of a difficult challenge just to being able to get invested in those products in the euro-denominated space especially.
Fantastic. Now, Scott, you're primarily in the deposit gathering and lending business that we're talking about here. And a week ago, Chairman Bernanke of the U.S. Federal Reserve talked about the possibility of tapering. I believe tapering was the operative word there, the undefined word, quantitative easing. How is this impacting your business? Are clients talking about reaching for yield or moving into longer deposit instruments, or are you still seeing good flows into the basic demand deposit accounts?
Tony, I think that our clients still have an enormous amount of uncertainty and generally are not extending out on the yield curve. From a deposit acquisition or deposit growth perspective relative to the banking industry, it seems that the first quarter was a bit of a lull, largely driven by the expiration of the transaction account guarantee program. So if you look at Q1 versus previous quarters or years of this year, the growth rate in total deposits was about half what it has been historically, and in non-interest-bearing deposits specifically, those deposits were down substantially. Interestingly, the decline in the deposits is really driven by the largest banks in the U.S. They account for something like 90% of the decline in non-interest-bearing deposits in Q1. That lull extended into the first part of Q2, but has more recently abated, and it appears that deposits have started to gather steam. Deposit growth in banks has started to gather steam again in the latter part of Q2. So it's an interesting situation where we find ourselves. Is this lull that we experienced a precursor to the end of the deposit surge, or is it just a lull given some of the changes? And on a go-forward basis, are we likely to see another increase in deposits? Certainly, the talk around tapering of quantitative easing might certainly just be talk, especially given some of the most recent statistics to come out. I'm not sure that anything's going to change radically anytime soon from our perspective.
Interesting. Now, Scott, you talked about the too big to fail and the TAG program. I'd like to come back to that. At year end in U.S. bank deposits were about $9.6 trillion, and as you mentioned, rose just slightly in the first quarter. Yet at year end is when the deposit guarantee program was eliminated. I think we had all expected to see deposits in U.S. banks fall after the guarantee left. They, as you point out, that at the largest banks they have fallen a little bit, but the overall number is up a tad.
Yes, Tony. I think that if you look in under those numbers a little bit, you'll see that non-interest-bearing accounts actually did decline. And that's just moving money around to where we're going. The depositors are going to get the most benefit. Once they lost the unlimited insurance, using that money to get direct interest, I think was an alternative that we saw customers take advantage of. Certainly. The non-interest-bearing deposits have fallen, but that's been offset by the increase in the interest-bearing side. So on a net basis in Q1, deposits were up just very slightly.
Interesting. Now, if we look further under the hood, we also see that one of the categories of those statistics, which would be deposits from non-U.S. headquartered banks doing business in the U.S., which are just under $1 trillion, so they represent about 10% of the total, actually grew by 10% in the first quarter, which is a huge burst of basically non-U.S. banks gathering deposits in the U.S. Debbie, you and I had lunch together last week, and you had some interesting thoughts about what might be happening there.
Well, I think to some degree, Tony, this could be representative of getting back to what would be the more normal state for those balances from the foreign bank branches. So, the problems with the Greek banking crisis and the contagion that occurred in the European marketplace in the middle of 2011, I think to a large degree drove people and balances out of those, even U.S. branches of those foreign banks, and even the highest credit quality ones that were not at all impacted or minor in a very minor way impacted by what was going on in Greece and some of the peripheral countries. And I think probably to some degree this might represent a regaining comfortability with those institutions, with those banking institutions, and therefore increasing exposure, building exposure back up to them at this point, but not necessarily a wholesale change in attitude, just sort of getting back to where they maybe were 2 years ago at this point.
Great. And Martin, from your perspective at the Association of Corporate Treasurers, and I know you have members from around the world, so you really have your finger on the pulse there. What do you see as the prevailing attitude toward deposits versus short-term investments?
Well, I guess the big issue that is brewing now is bail-in. And this is the concept where governments no longer wish to be the people who end up bailing out failed banks, but instead are trying to invent a set of rules where the bank creditors all take a hit if something goes wrong with the bank. The big question mark is which of all the different bank creditors takes the hit first. And so the particular worry for corporates is what's the position in the pecking order for wholesale bank deposits. And certainly, you know, the experience back in Cyprus was that the bank depositors, even the retail depositors, were hit. I mean, what we're seeing in Europe is these rules on how bank resolution and recovery will work are being discussed at this moment in the Parliament. And I actually gathered the breaking news this morning was that we've moved somewhat further to understanding how it will work. Because the critical point is who actually has the authority to say this bank is heading downhill, we will invoke the new bail-in rules. So there's been some movement this morning in trying to figure out which authority, whether it's the central bank authority or local bank, central bank, that has the say on that.
And I'll point out there was a piece in this morning's Financial Times online edition to that exact topic. It's kind of an interesting conundrum, though, because we see deposits increasing, even though there's uncertainty about where the losses would be taken in a failed bank. Well, you'd think that'd be driving monies out of banks, but we haven't seen that. Martin, while you're up and online, question back to the ECB and the decline in reserve balances. How does the LTRO program from about a year and a half ago factor into this? You know, at that point, I believe the ECB pumped about 300 billion euro into European banks with 3-year term, but allowed for prepayments beginning at the 1-year mark. Does that factor in?
Well, certainly the central bank has been very accommodative in terms of its monetary policy, and the intention is that continues. Notwithstanding the thought about tapering in the US, we've been hearing here in Europe that the central bank and our own Bank of England are saying that it's effectively premature to see the end of that sort of quantitative easing and assistance of pushing money into the system.
Interesting. I'd like to switch gears now and move to Basel III. Moni put up that slide that showed the corporate finance will be impacted, and in some sense, the banks who played a key role there will find their role shifting a bit. So I'd like to turn to Scott. Clearly, you will have different capital requirements, different liquidity and funding measures. Could you share with us how you are preparing, or if you are preparing for Basel III, which is still a couple of years down the road?
Well, we are certainly preparing for Basel III. I think that from our perspective, the impact will be in treating different customers in different ways. Certainly from a liquidity coverage ratio, the intent is to treat retail customers different from corporate customers, and corporate customers different from financial institution customers. And I think that as we prepare for those differences, we've got to evaluate our customer base in ways that we hadn't done before. So I think all banks are in this situation where there are certain customers that will be advantaged by the types of deposits that they hold with a particular bank, and others that will be disadvantaged. And we're certainly looking at new and different product options that might meet the needs of those customers while still working within the framework that Basel III sets out for liquidity coverage ratio.
So Scott, what would you tell, or what is PNC telling its corporate clients with respect to Basel III? Is it sort of sit tight and we're going to have products for you, or you need?
Certainly, you know, I think that what we're telling our clients is that you know, the part being more of the full service relationship is more important than transactional business that is once and done. Certainly, we are looking at it from the perspective of the types of activities we do with our customers and how those activities feed into the classifications within Basel.
Okay, Debbie, I'd like to ask you, with respect to Basel III, you know, if banks have higher capital requirements or more restrictive liquidity requirements, do you see that benefiting, or do you see assets moving into the money market fund realm, or do you think they're going to go further off into the shadows?
We do think it will have an impact on the money market side of the equation. Where it impacts us even more, though, at least in the current phase, as the banks are sort of trying to phase in, the various requirements and stepwise get in tune with them, is that there has been a drastic cutback in supply. So certainly as the banks, and I think we talked about this maybe on the last call too, as the banks have continued to be incented from their regulatory oversight, and Basel III in particular, to fund themselves with longer and less risky but more steady state funding that is years in length rather than days or weeks or months. At the same time, we on the money fund side of the equation have been required and incented by our regulators to shorten our weighted average maturities, our weighted average lives, the maximums, as to how we'll, what we're using for funding mechanisms within the money market funds that we manage. And so, sometimes you end up with two circles that have no common meeting point. And although we're not quite there yet, that's the danger that we see going forward. That additional demand for our product be driven our way, which is a good thing. We're certainly not arguing about that, but that the potential for then continuing to invest in a way that we think is, very high quality and least risky and most averse, some of those opportunities may be taken away in the context of the banks that we're typically dealing with on a day-to-day basis no longer requiring or being incented to use short-term funding even for, what would be the liquidity portions of their books.
Very interesting. Now, Martin, when we were together a couple of weeks ago, you were talking from your members, your corporate members' perspective. Basel III seems to be finally getting some traction on the corporate side. Corporate treasurers are beginning to anticipate some impacts. Could you share with us what you're thinking there?
Yeah, well, I mean, Basel III has an impact on all manner of different things that treasurers are doing. The one that's coming through most obviously is the perception that banks will be less willing or have less capacity for straightforward lending, and as an alternative, those borrowers who can are turning to the bond markets, which I think is very much what your survey was saying people would be expecting. So that's been happening both on the international bond markets and indeed to some extent on the private placement markets. I think that one's a particular interest because obviously in the US you have an excellent private placement market, and indeed foreign issuers are coming to fund themselves on that market. But equally we'd quite like to see the development of an equivalent market in various countries in Europe. It's beginning to happen, but certainly that's a trend that we see is likely to continue going forward.
Wow, interesting, very good. I'd like to turn to a topic that I think is top in mind for most of the treasurers that we at Treasury Strategies work with, and that is the next chapter of money market fund regulations. Some people call them reforms, I call them regulations. I think there's a fundamental difference. The Securities and Exchange Commission has issued a proposed set of new regulations, and the European Commission is expected to come out with its proposal shortly. Debbie, could you begin by sort of taking us through the key elements of the SEC proposed regulations and what this means for your customers?
Absolutely, Tony. It's obviously something that's near and dear to our hearts at this point. The SEC actually officially released onto the Federal Register as of last week, I believe it was the 19th of June, the 698-page document that is the proposal for modified regulations for money market funds here in the U.S. Just a couple interesting statistics about this proposal. It's about 225,000 words, and in contrast to the last time there were proposals for modifications to money market fund regulation, which was in 2009, that document was about 200 pages, and in contrast to the word side of the equation, some of the more popular things that I've seen that compared to the U.S. Constitution with all of its amendments has only about 8,000 words. And go back, I said this had 225,000. The Lord's Prayer has 66, and the novel Moby Dick has 212,000 words. So obviously this is something that the SEC has spent a lot of time and energy in making sure that they were attempting to provide a very thorough document. So we think it's inclusive, we think it's well crafted, and certainly provides options that make sense for continued consideration in the marketplace for U.S. money fund firms. Alternative 1 quickly offers a variable net asset value for institutional prime funds. And the definition that they're using to define institutional versus retail is that a retail fund would be exempted, and a retail fund would be any fund that does not allow a single customer to have more than a $1 million redemption on a single day basis. In that same alternative 1, the institutional prime fund would be floating off of a $1 basis, but that $1 would be carried out to the 100th of a penny. So it would be 1 and then 4 decimal places to the right of the 1 in order to price that on a daily basis and see variation.
That sounds like an operational nightmare.
It does sound like an operational nightmare. There are a lot of problems with that particular alternative, and I think obviously that's one that we will need to spend a lot of time on with corporate treasurers and with banks in the marketplaces to how it would impact them and their operations, and we think that that's a pretty drastic impact. It also exempts the government funds, so retail and government funds are exempted from alternative 1, so just the institutional prime. For alternative 2, they're proposing a liquidity fee and potential gates be allowed, and again for non-government funds at the discretion of the board of directors, where some sort of a trigger, and as they're proposing it in alternative to be a point at which the board would then be looking at whether these fees and gates would be imposed. The trigger that they are suggesting in Alternative 2 in the proposal is when weekly liquidity assets. So this was a new measure of liquidity that was undertaken with the 2010 amendments that requires funds to have at least 30% in weekly or less liquidity, so 1 through 7 day liquidity, be at least at 30%. And the proposal in these 2013 suggestions would be that once that level of 30% reaches 15%, i.e. it's halfway depleted because of redemptions essentially, that is the opportunity at which the board would then decide whether they wanted to impose some sort of liquidity fee, and again they're suggesting potentially 2% or less for investors that do need to exit the product still, or to put up some sort of a gate with a period of time during which then the resolution to what that gate would be brought back to the shareholders. So that's essentially Alternative 2. They also then have a group of what I'll call other suggestions, whereby they would be looking to improve either diversification, disclosure, or stress testing as it's currently undertaken and provided by the fund industry. And again, just sort of on a background basis, I would say our big 3 surprises, if you will, in the context of this release, because all of those things that I just outlined to you, Alternative 1, Alternative 2, and then the other suggestions, were sort of what we had thought was going to come to bear. The surprises were, number 1, the elimination of amortized cost. So it doesn't really matter whether you're looking at Alternative 1 or Alternative 2, whether you're looking at prime funds, government funds, retail funds, institutional funds. The proposal across the board is suggesting the elimination of amortized cost pricing and the full mark-to-market pricing on a daily basis for all products, whether it be to the 2 decimal place level for government funds and retail funds, or to the 4 basis point level as they're suggesting in Alternative 1 for institutional prime funds. That creates a whole host of issues with regard to cost, efficiency, and potentially even same-day capabilities within the funds because of the pricing problems that would be undertaken with that change. The second big surprise would be on the muni side, where they don't seem to actually address munis at all. And to some degree, we think maybe they think they're addressing it in the exemption for retail funds, but that's something that also needs to be clarified and brought out more fully in the context of the next 90 days as we're all looking to respond. And then thirdly, the very last surprise would be the definition that I gave you for retail, whereby it's defined upon the maximum amount that can be withdrawn on a daily basis by a single customer being no more than $1 million. So those things were surprises, things that we're obviously key focusing on, but on a balanced basis, this was very well received, I think, from a marketplace standpoint.
Thank you, Debbie. What a great synopsis, and certainly a lot for corporate treasurers to think about, a lot of different ways to be impacted. Now, Martin, I believe you said that the European regulators are expecting a draft of their proposal within a few weeks?
Yeah, certainly that's the expectation, and there's been plenty of sort of rumours and indications in the market ahead of that. I mean, very briefly, it's similar to some of those SEC proposals, but different. Certainly the move towards variable net asset funds is one of their intentions. Instead of going for redemption gates and liquidity fees, the European concept, we believe, is heading more towards requiring funds to hold a certain level of capital, and they're talking about 3%. But that would sort of destroy the economics of that particular model of keeping a CNAV fund with capital. So we're waiting to see the full details, but in a way, subject to some of the details that were just explained then, we're half thinking that some of the US proposals are probably more attractive.
Interesting. Now, Scott, let me just close with a comment from you, and I will point out to the audience the PNC, I believe, owns 21% of BlackRock, so you are front and center in the money fund debate as well. You kind of have a foot on both sides. That must be ripe for some interesting debate inside of PNC and certainly product development that you're undertaking.
Certainly, from a product perspective, Tony, it's interesting. One of the things that we think is that they'll do something. Some of these things will come to bear that will have some impact on the industry, and we are currently evaluating what will that do to the demand and how we manage products like the sweep to money market mutual funds. To the extent that we do that today and we allow customers to move that money very efficiently, when you have things like potential gates and fees that you don't know whether they will be applied or not, it creates a whole lot of additional risk to that particular product. The same kind of thing happens from a variable net asset value. If you don't know what the actual value is, how do you then allow customers to move money back into their account to cover other disbursements if there's changes there? So we are watching it closely. There are lots of discussions ongoing, and largely we'll figure this out based on demand from customers, based on how customers will react to these changes, and we will adjust our products and services in order to meet that new demand.
Fantastic. Well, thank you, and I'd like to thank Martin and Debbie as well, Scott, for such a great overview. Very quickly, I'd like to point out that when Treasury Strategies looks at these regulations, we look at this from both the perspective of our corporate clients and our financial institution clients, we think the impact of these money fund regulations, which represent, trillions in total assets, and are a cornerstone of the financial system and capital markets, we think that the consequences are very serious. The operational cost of transitioning to this environment is much more expensive than folks realize, and what the top line we have on this next slide in terms of our advice to clients is now is the time to speak out. We're seeing very concrete proposals on the table. We're probably getting very close to action, and it's extremely important that particularly corporate treasurers speak out on the issue. When and I'm speaking worldwide here. In the past, the industry and several financial institutions have carried the water in commenting both on Basel III and on money market fund reform. The corporate side has been willing to sign on letters by various organizations like the ACT and others, but we think now is the time to respond directly on your own letterhead. It's kind of speak now or forever hold your peace. I think we're getting down to crunch time there. So with that, let me turn this back to Moni to summarize and wrap up.
Yes, thanks, Tony. And we realize we've run out of time, but thanks to everyone for joining us. And a particular thanks to Martin, Debbie, and Scott, our panelists. Look for our invitation to the briefing next quarter. And for the corporates on the line, be on the lookout for our next survey and take a few minutes to complete it. Your input really is very important to the ongoing assessment of trends and impacting cash levels. Thank you, too, for your questions. We'll answer them and circulate to all who've registered, and we'll also send you a copy of the report. We encourage you to look at our sponsors' websites and our website for further articles and commentary, and to reach out if we can be of help with your liquidity forecasting or technology strategies as you navigate these uncertain times. Thank you.